Good morning. Lovely to see you all. Seen a lot of familiar faces, which is really nice. First time we've been out face to face for some time, so really good to be back. Going to present today our summary from our results that were released last week. Just two of us presenting today. So I'll do a bit of an introduction, some highlights. Qadeer, our new Director of Finance, will do the financial review. I'll then give you a strategy update and a summary, and then I'm joined today by Paul Forster, our new Non-exec Chair, and Martin Stevens, our Group Manufacturing Director and Deputy MD, and they'll join us for questions at the end. So I'm hoping this is about 20-25 minutes, and then we've got plenty of time for a Q&A session. So just a reminder of who we are for anybody that's new in the room or hasn't seen us for a while. Creightons is in the beauty sector, beauty product sector. We design, develop and manufacture and distribute high quality beauty and personal care products into the market. We have three routes to market. Private label, where we design, develop and manufacture for key retailers with their own brand name. And that can range from anybody from Aldi to Asda to Tesco to Marks and Spencer's to Superdrug to Boots. We have our own brand portfolio that we own, and then we do contract manufacturing for a number of other brands, which is more of a transactional business where we literally just manufacture product. We don't get involved in much development. We don't get involved in marketing or distribution. We just perform the role as a manufacturer. There's now about 400 of us. I think it was actually 406 this week. Just over 400 of us, over 2 manufacturing sites in the UK, the larger one and the head office in Peterborough, where there's about 300 of us, and all of our head office functions are there. And then we have the site down in Tiverton. Those of you that know us well, we purchased that about 6 to 7 years ago. It was a distressed business. It has some capabilities and some nice customers that we did an asset buy on, and does very well for us. More of a standard, just contract manufacturing function down there. In all levels of what we do, we're a full service supplier. So that means we do everything from development where customers want us to, all the way through to distribution. And for ourselves, we go into international markets with our own brand. So our private label business is predominantly UK. We have one big private label customer, believe it or not, in Saudi Arabia. The Middle East comes to the UK for private label because it doesn't have that kind of function out there in terms of industry. But that's all in the UK. But in terms of our brands, about 30% of our brands are in international markets. So international, quite a big piece. Business split in terms of where we are for the financial year we're discussing, with private label 45% of our total revenue currently, our brands at 39% and contract at 16%. So just some real top line headlines on the financials. There's been an improved operational performance this year, despite the lower revenue. I'll explain in a bit more detail where that lower revenue has come from, but the good news is the margins are stacking up. So we've improved margins quite significantly over the period, which has delivered a bottom line pre-exceptional operational profit that is improved as a percentage, improving the EBITDA and also improving the cash. Obviously, there's lots of other things that have happened that have improved that cash that we'll talk you through. Proposing a dividend and an improvement on the EPS as a result of the improved earnings. Operational highlights in terms of what's driven those results. We've had a reduction in overhead by 1.5 million. We've continued with our cost price implementation with retailers that really started in earnest when inflation hit a couple of years ago, and that's now an ongoing program that we have in the business. We've improved manufacturing efficiencies. Those of you that know us will know that about 18 months ago, we took both late shifts out of our business. So we just operate on 1 day shift in both sites. We actually thought at the time that was a huge challenge for us from a capacity point of view. We actually became more efficient. It's amazing if you don't have that extra space and that extra capacity, what you can deliver by really looking at yourselves and delivering extra efficiencies. So the operation and manufacturing teams have done incredibly well to deliver better efficiencies by just going to 1 shift. Reduction in stock has been a key feature this year, driving the cash. We also have completed our restructuring of our warehousing. We had at one point probably about 75 to 80% of our finished goods externally in 3PL. We started bringing that back last year. At March, we had about 40% in-house. We now have 75% in-house. So we still have a 3PL, but just for one customer. And we are still creating space, which is really quite interesting. It's much like the shift thing. If there's warehouse space, you'll fill it. If you don't have it, you have to think about different ways to make it more efficient. And that's what the teams have done, which has been super positive. And that's also driven about 300,000 into the business in terms of saving. And then the other thing is we have fully integrated the Emma Hardie team into the Peterborough site. When we bought the brand, it had an office in Rickmansworth. The team was kept down there. It was kept quite independently run. with the original founder that stayed on for a period of time. That has now completely evolved. We've bought the Emma Hardie team. We've closed the office in Rickmansworth. We've brought the whole Emma Hardie team into the Peterborough site, which I think in terms of moving forward with that brand is a really positive step forward. So I'm just going to hand you over to Qadeer that's going to take you through the financials.
Welcome and thank you for your time today. My name's Qadeer. I'll go through the slides for the financial review. You probably have already seen our operating results so far in our prelim announcement, but despite a revenue reduction year on year of 9.2%, the group was able to generate improvements in gross profit margin, which effectively translated to improvements in operating profit and then ultimately cash generation. The revenue reduction really is a result of two main points: the challenging market within contract and branded sales, which I'll come to on my revenue slide, but private label saw an increase year on year. And also we undertook a strategy to rationalize the SKUs. So any SKUs that weren't achieving a contribution margin that was commercially viable, we decided to effectively exit from that. The gross profit margin improved year on year by 1.3% to 42.9%. Again, a challenging macroeconomic environment meant inflationary pressures across cost of labour, raw materials, componentry and commodity had the impact of eroding the gross profit margins. Now, the group took actions to mitigate those eroding margins over the past couple of years, but really those actions involved product re-engineering, reformulating and increasing customer selling prices. The decision for SKU rationalisation was also combined with cost rationalisation. So effectively, we had to implement the strategy of aligning the business's overheads to match its current level of sales and manufacturing output. And that aided with improving the operating profit margin despite a reduction in revenue. So that improvement was 2.9% compared to 2.7% in the previous year. So that improvement in the operating performance of the company led to an improvement in our EBITDA. So 3.2 million of EBITDA was generated in the year to March 2024, previous year 3 million. Again, combined with working capital improvements, stock levels dropped by 2 million, and other working capital improvements such as debtors and creditors of 0.6 million, we were able to generate net cash on hand increasing to 2.2 million, and prior year it was negative 1.2 million. So net cash on hand just being defined as cash on hand less lease liabilities, borrowing, etc. Revenue streams. So this graphic goes back over the past 4 years in terms of the revenue streams and the composition of those 3 revenue streams, full year sales. So 2021 year, a bumper year really at 61.7 million, 24% of that was hygiene as a product of COVID, and that is featured within branded sales. So as I mentioned previously, private label increased by 7.9% to 23.7 million. Again, that's really a testament to the team and the manufacturing capability we have in the private label space. You know, our ability to produce manufacturing volumes at quality, consistency, and speed of supply is evident in the increase in private label number. Branded sales decreased by 7.6 million to 21 million. So that was largely down to 2 reasons. We lost probably about 1.8 million pounds worth of sales to an international distributor who effectively lost distribution as a result of diversifying their business too quickly. Again, that had a knock-on effect in terms of volumes ordered from us. Secondly, branded was, of the 3 revenue streams, branded was the main revenue stream that effectively was impacted by the SKU rationalisation. So we cut SKUs, probably about 45% of the SKUs were exited, again, because they weren't able to achieve a contribution margin that was commercially viable. Contract decreased by 38.9% to 8.5 million. Again, 2 main reasons for that. Contract customers who weren't able to get credit, we basically exited and weren't dealing with them. So we have a strict policy in terms of credit and managing that credit risk. All of our debt is under credit insurance, and that's covered up to 90% of the debt value. So that was one of the reasons. And the other reason was contract customers, their order books effectively reduced as a result of end consumer demand. So again, that had an impact on the volumes that effectively they were ordering from us. Again, so that's revenue. Moving on to operating profit before exceptional costs. So again, despite revenue reducing, we were able to generate an improvement in operating profit margin, and actually it was comparable year on year despite the revenue reduction. So you can see the chart on the right hand side, we go from 2017-18 to the current financial year, and effective 2 years of consistent operating profit before exceptional costs, getting back to the 2017-18 years. Again, 2021-22 kind of a bumper years as a result of COVID, really. And just a bit of detail, really bullet pointed below in terms of how we're able to achieve that operating profit before exceptional costs. Obviously, there was a 6-point plan, which I'm sure you're all aware of, but moving stock back in-house, reducing manufacturing volumes, really assisted with decreasing the distribution costs year on year by 10.6%, which is a great achievement. Admin expenses decreased by 5.6 to 17.8 million. Again, a strategy of cost rationalisation to align the business's overhead base with its level of turnover really aided with that. I think one thing I haven't put in there really is the manufacturing efficiencies as well. That's aided not only from a cost of sales perspective, but also in terms of efficient utilisation of the factory. Again, utility costs have come down, but because of that efficient utilisation of the factory, we're able to get even more saving there. So how does that operating performance effectively lead into cash generation? So hopefully a simple and kind of playful graphic just to show how that moves through to cash generation. So operating activities, as a result of the strong operating performance, generated cash from operations of 3.4 million. Combined with the working capital improvements I mentioned earlier, inventory reduction 2 million year on year, debtors and creditors 0.6. So combining operating activity as well as improvements in working capital generated £6 million worth of cash inflow. Cash outflow consisted of investing or core investing activities, so purchase of plant and machinery, equipment, intangible assets defined as product development costs, which is capitalised on our balance sheet. That was an outflow of 600,000 for the year. Borrowings, repayment of lease liability, mortgages and the term loan was a cash outflow of 3.9 million. And given obviously we had a strong cash inflow of 6 million, a decision was made to repay the debt of the term loan, and we paid 50% of that balance, and we're looking to clear that loan over the next couple of months as well. So from a gearing perspective, we'll be very lean and we'll just have the mortgage left on the property. So combining those four items really gives us a net increase on cash on hand of 1.5 million. A bit more detail on working capital. So stock level decreased by 2 million year on year. So that was targeted reductions in purchasing quantities as well as manufacturing batch sizes, thereby enabling us to effectively move out of third-party logistics and bring them back in-house. Stock turns is quite an important metric for us, and it's improved and increased against the previous year. So 3.7 times against 3.3 in the previous year. Again, a measure of how quickly we are able to turn that stock over, not hold it for too long. Again, minimises holding costs as well as stock obsolescence, an important function for us as a business to minimise. Trade debtor days, again, 2 million of that has dropped year on year as a debtor book, by actually collecting cash more quickly as well as improving cash flow and providing funds for daily operations, investments and debt repayment. The creditor days, again, with our purchasing quantities reducing, we're able to decrease the creditors by 1.6 million compared to the previous year. You may have seen before the preliminary results, we had an announcement on Emma Hardie and the impairment of Emma Hardie. So under IAS 36, any capitalised brands or goodwill value, we have to assess for re-impairment on an annual basis. As part of that reassessment, we have to look at historically how Emma Hardie as a business has traded. So following that assessment, we deemed the brand value acquired on acquisition of Emma Hardie to be impaired by 4.4 million. Now this is shown as a separate line item within our consolidated profit and loss account, which is non-cash impacting for the current year. And the corresponding entry effectively goes out of the brand value. So the closing brand value is 0.66 million, and the goodwill was de-recognised against deferred tax liability that was also sitting on our balance sheet. So from a cash impact, no impact. It's just almost an accounting entry or book adjustment to the brand value that we capitalise on acquisition. Finally, from an operating profit perspective, we're able to align the board's objectives of operating financial performance with shareholder value. And ultimately, we have been in position this year to propose a final dividend for the year ended 31st of March, and that's 0.45 pence per ordinary share. And the aim, the ultimate goal of that dividend is to make sure it is sustainable. That's the key thing, and that's what we strive to do as a business. And hand over to Pippa.
Thank you, Qadeer. So some insight onto strategy in terms of where we are and kind of the key pillars moving forward. I'll run through these one by one, but private label, core brands, new brands, digital sales, R&D, our manufacturing strategy, and then of course the environment and sustainability, which is a necessary step that we have to make sure we are taking care of. So develop and cultivate private label is at the top of our strategy. It's a very important category for us. It's one in which we are continuing to grow. It's one in which we are one of very few players in the UK that do this full private label service operation. We now have 8 customers in the UK in 14 different beauty categories, and we do about 356 SKUs. So it gives you kind of an idea of the size of it. That has actually moved up to 9 customers because there were 2 retailers that we were not doing private label for in the UK that we targeted, and we've now got both of those. So one was Marks and Spencer's that we just started trading in March, and the other was Lidl, which we start trading in September. So that will move up to 9 customers. What's really important in this category is that we work with best-in-class retailers. Best-in-class retailers execute private label really well, which really mean we're on the same page with them in terms of being able to develop product, do the right thing for the consumer, and move these categories forward. R&D development is absolutely critical. I'll talk a little bit about that in a minute, because R&D we consider to be one of our big pillars in our business. And actually, for me, in many respects, it's one of the biggest assets that we have in the business. Our formulation bank and formulation profile that we have in the business is a phenomenal asset to do what we do. It's a UK supply situation, which I mentioned earlier, because it's lower cost, so you want to be able to get local supply for both speed and cost. And for us, focusing on margin positive products. So Qadeer's already highlighted, we did quite a lot of SKU rationalization last year. Branded was the big one, but we also did quite a bit in private label too. So if there were SKUs in private label with retailers that were not hitting the margins that we wanted, we have exited. Build and develop our own core brands. So just wanted to give some insights here as to what's happening in that area. We've also refocused here. We were trading about 8 brands. We've gone down and focusing just on 6. And I think this point about focus is coming through the presentation, hopefully, in terms of where we position ourselves as a management team. So that's our Creightons brand, our Balance Active brand that we purchased 4 years ago, Emma Hardie, T-Zone, Feather and Down we created in-house, and Curl Company we created in-house. So you've got a combination of brands up there, 3 brands that we've purchased and 3 brands that we've created in-house. Creightons is still, in terms of our total revenue contribution on brand, is still our biggest brand, then Balance and Emma Hardie. And as you can see, we've had a bit of a hit on all 3 of those. Creightons suffered from the SKU rationalization the most. We trade that predominantly in discount and mass grocery, and that's where we discontinued most of our SKUs that were not performing. So Creightons is actually doing quite well, and we've got new listings for Creightons, and we've got hair care and skincare in there, and self-tan and a number of other things, but that's what's happened there. Balance Active was the point Qadeer made. One big distributor out in Vietnam was doing phenomenal business for us for years, diversified their business really quickly, took their eye off the ball, and lost lots of listings within a year, and that was a big hit on us. But interestingly, Balance is getting new listings and growing quite nicely in other areas. Emma Hardie has sort of stood still, hence the impairment. When we purchased the brand, it was turning over 3 million. We're still turning over 3 million, hence the impairment. We had aspirations we'd be able to grow the brand faster than that, and it sort of stood still. T-Zone doing very well. Purchased that brand almost 3 years ago from Brody & Stone. Doing very well in terms of moving it forward. It was predominantly in the discount sector. We've moved it into Tesco, we've moved it into Asda. We do great business with Superdrug. So we're kind of trying to move the brand upwards in terms of its distribution profile, albeit it does very well in the discount sector. Feather and Down is moving forward, which is quite nice. It is a UK brand. We haven't taken it internationally yet, but we're about to get our first international listing for Feather and Down that starts in September in 300 stores in Spinneys in the UAE. So that's starting to take Feather and Down internationally. And then the Curl Company, which I think is a bit of a sleeping giant for us, and we're going to put a lot more resource at this brand because it's doing very well and we do very little with it, and predominantly trades internationally, interestingly, albeit we've been in boots for 6 years with the brand and doing very well in terms of its performance. So I just wanted to kind of give you the size of how many customers we're in, how many stores we're in, both UK and internationally, and some of the new listings that are happening. One of the things that we've been doing with Emma Hardie is the big focus with Emma Hardie over the past few years has been China. And there's been big investment to get the Chinese market moving, and that has not worked. The Chinese market has changed dramatically in the beauty industry over the past 12 months. So we've currently got that strategy on hold, and I'm reassessing whether or not we re-enter China. A lot of investment, though, in trademarks and a lot of investment in getting products registered domestically, which actually puts the brand in a really good position for China. It's just whether or not the investment and the return on investment is going to work for us in China, and whether or not we can get that somewhere else. So what we've been doing for the past 6 months is actually changing the strategy on Emma Hardie to move it into the travel sector. I think there's a great opportunity for travel for Emma Hardie, and as a result, we've gone onto EasyJet for the first time. That's our first on airline opportunity, and we are currently doing a 6-month trial at Luton Airport. So if any of you go through Luton Airport this summer, please see our girls that are in store on the duty free with Emma Hardie. So far, so good. We've been in for 6 weeks. But talking to lots of other duty-free around the world, talking lots of other airlines, it's a great opportunity for a smaller brand to get lots of eyes on brand and lots of awareness. So pursuing a travel strategy there at the moment. Expand with new brands. That is something that is on our radar. Definitely consolidating and getting the brands that we've got performing, but would like to add more brands to the portfolio in time, whether or not we create them in-house or whether we acquire them. And it would really need to fit some of these key criteria for us. I think we've done very well with Balance Active. We've done very well with T-Zone. I think we've learned a lot of lessons in terms of what we do well and when we can get a brand, what we can do with it and where it needs to be in the market for us to do that. So there's been a lot of learnings over the past few years, which have been very positive. So yes, it's got to fit with what we do. It's got to play to our strengths. It's got to fit the white space. So that's really important in terms of getting a brand that's meeting a consumer need that's currently not being met or is being underperformed. And where the sales and margin obviously add value to our business in terms of how we can move forward. Big area for us, R&D and category expertise. This is really important for the private label business, but it also obviously makes a big difference to our brands in terms of the products that we can launch and what we can do with brand. And one of the ways that we will continue to grow private label, so we're pretty much dealing with everybody in the UK that we would want to deal with that's good private label business, is to go into different categories. So we're already in about 14 different health and beauty categories, but there are still others that we can go for. We've spent the past year with Martin Stevens and his technical team investing in SPF development, which is a really big move forward in skincare. It is absolutely what skincare is about and will continue to be what skincare is about. Everybody knows it's in the general conversation that you need to protect your skin, not just in terms of sun protection products, but in terms of facial skincare. And there's some really exciting formats and textures and different things that are happening. So we're putting quite a lot of money in terms of R&D investment behind SPF development. Speed to market, obviously always important, and that's key with our R&D team in terms of how quickly they can develop products, which means being on trend, making sure we know the right ingredients, right product textures is a big thing in this category now in beauty. Everybody wants a product that looks and feels different and does something different and just delivers something different. So we're investing a lot in product textures as well. And again, as I said, new product types, new related categories. We're looking at the healthcare category for private label for non-licensed, non-medicated products. There's actually a lot of products in that space that we could manufacture and fill. So that's another category that we're looking at for private label to move into. And then evaluation of materials with low carbon footprint and more sustainable products. I mean, this is a key one in terms of keeping things moving and making sure that we're hitting those kind of targets, particularly for the private label business. Retailers have their own strategies for what they want to achieve in terms of environmental and sustainable standards. So it's important that we're on the mark in terms of where we're sourcing and we're credibly sourcing ingredients down the supply chain. Build on digital sales. So this has been a key feature actually over the past couple of years for our branded business. We weren't trading on Amazon 3 years ago. We do about 3.5 million on Amazon now. And I have 3 full-time people in-house managing our Amazon business. We operate on both vendor and seller. Vendor is our bigger piece. And actually Feathering Down is the big star on Amazon, interestingly. Balance Active does very well and so does Curl. For those that aren't aware, Amazon is not actually a branded site, it's a product site. So really we work on a product basis rather than a brand basis. So whilst you have brand shops, you really focus on individual products and looking at your competition on those individual products. But we've recently moved on to seller with our higher price points because seller is actually a more expensive avenue to go. And we've worked out you need a kind of an £18 price point and above to successfully work with the right margins on seller. So we've recently moved Emma Hardie onto seller, and we've recently moved a brand I haven't mentioned yet. We picked up when we bought T-Zone an oral care brand called Janina, which is a 15 and 19 price point toothpaste brand for natural whitening. And it's had a listing in Boots for 10 years and it's in 1,200 stores in Boots and actually does very well. We have spent honestly very little time on it, but we saw an opportunity to get it onto seller and it's doing our initial few months that we've been on seller are super positive, but the retail price point allows us to work effectively on seller. .com, honestly, we're only focusing .com on 2 brands, and that's Emma Hardie and Feathering Down, and it's because it's all about price point. You can only make the .com work and come to your own .com if you've got brands with enough retail headroom in there that you can deal with all the costs. You've got to compete with Amazon. You need to offer the free delivery. You need to be able to do all the things that you compete with Amazon. So .com a priority for us, but just for 2 brands. And then growing our relationships with pure players in the space. So working with people like Look Fantastic, Sephora, Next online, Marks and Spencer's online. Again, Emma Hardie leading the charge. 60% of Emma Hardie sales are online. So whilst Marks and Spencer's and Space NK are our big bricks and mortar retail opportunities, we also do very well with them online. And again, with the Sephora's and the Look Fantastics and various things. So growing our relationships with other key beauty players is key. Manufacturing strategy. A little bit of manufacturing going on in our Devon site. This is one of our Emma Hardie products, our vitamin C product that's now our number 4. We relaunched it and developed a new formula and put it in a new gold jar, doing quite well for us. The manufacturing strategy for us is about focusing on efficiencies and outputs and improving ourselves in terms of what we're able to manufacture. So our capital investment is focused on output capacity and efficiency, and we want to start focusing on AI where possible to get more efficiencies out of manufacturing. Keeping the cost footprint that we do in manufacturing in line with our profit and sales profiles. Training programs, really important. We're trying to upskill our manufacturing teams as much as we possibly can. We've got a lot of MBQ programs going in. We're using the apprenticeship scheme quite heavily, which is very positive, and upskilling throughout our entire business through training programs. Operational control in terms of using technology to keep ourselves cost controlled and keeping ourselves and making sure our investments are paying off. And then obviously hitting environmental and safety requirements, which is necessary. And then finally, it's not the sexy stuff, but it's what we have to do. To meet our own standards, to meet the standards of the retailers that we work with, but also there's audit standards now in terms of these particular targets. Just, I suppose, a couple of call outs there that are important for us is the RSPO accreditation and the palm derivatives. Martin actually is one of the leading people in the country in terms of understanding sustainable palm. We've been doing it longer than most manufacturers in our competitor set in the UK, and making sure that we're using sustainable palm sources in the products that we manufacture. So that's a key one for us, but also recycled packaging. Obviously, we've moved into PCR, our brands and private label. That is continuing single-use plastics in terms of complete recyclability, making sure that everything's made out of recycled plastic. Quite a big piece that's going on there in the background. So in summary, we've achieved profitable operational business and we've returned to positive cash. We're focusing on value-generating profit growth areas in channels, customers and products. Continuing to invest in our brands. We've restructured our sales team. We've got a new director of sales that's come in. She's been with us now for about 8 weeks, so that's super positive. She's brought in a new head of UK sales on brand. We've also brought in a new international business development manager to shore up our international sales, which is important for our brands. Continuing to do marketing investments, obviously in the trade. If you go into Tesco, go into Asda, go into Boots, go into Superdrug and see our brands, you'll see banners, you'll see shelf strips, you'll see fixed trays. So investing in that kind of POS material, which is really important to help your brands stand out. But also social media. We have 4 of our brands on TikTok. T-Zone actually does the best. We have Balance Active. We're about to take Emma Hardie onto TikTok and TikTok Shop, and also Feather and Down. So been participating in Facebook and Instagram obviously for a long time, but TikTok is obviously the important one moving forward. E-com platforms, where they're profitable, we will extend them and extend our distribution with an international focus. Strong momentum in the private label revenue stream, which I've explained, doing very well for us. And I actually think one of the most important points of today is I've got a refocused, very highly motivated senior management team. We've brought in new people. We've done lots of internal promotions over the past 6 months, giving lots of really good star players in our business, lots of headroom, lots of ways to move forward, lots of structured training programs. And I think for me, that's probably one of the most important things and the assets that I've got at the moment. Actually quite a young team. It makes Martin and I probably the oldest in the business now. So we've got a very young, energetic, talented team, which is very exciting for all of us. So, questions? And I'll be joined by Paul, our non-exec chair, Martin Stevens, our manufacturing director and deputy MD, and obviously you've met Qadeer.
Hi there. So John Cummins, Zeus Capital. The first question, just around the SKU rationalisation, was that done in a phased approach throughout the last financial year, or did you do that in one hit?
Yeah, hard to do. I'd like to do it in one hit, but when you've got stock you've got to sell through, it doesn't necessarily happen in one hit. And I wanted to get as much out of that stock as possible. So yeah, it was phased.
So this will be the first financial year that you'll see the full year benefit?
Yeah, kind of back, first full financial year.
And then focusing on the operating margin, is it going to be volumes going in terms of actually expanding the operating margin from here, or is there more efficiency to go for, plus on top of the SKUs, and where do you think you can get that operating margin to over the next few years? Thank you.
I think you're quite right that I think the story that we're painting is we've got a very well-controlled, streamlined business, and actually the sales revenue piece is the important piece in terms of putting the foot on the accelerator and moving the business forward. So that's definitely a big part of it. But I also think there's still some efficiency gains to be had. I still think there's some we can get out of stock. And I know they're kind of one hits, but there still is some opportunities there, particularly around obsolescence and keeping our eye on the ball of obsolescence, because in a branded business, that's always something you have to keep your eye on. I think there's more that can come out of manufacturing with some investment, but probably not as big as you would think. I think there are some small wins that could give us some gains. Just a bit of diversion there. And credit to our operational teams, they have built a new manufacturing line from equipment from other lines we've decommissioned recently. And that's added 9% capacity to our Peterborough operation, which is really fantastic. And all it cost us was labour in terms of our own people to build it. And that was operational from the end of June, isn't it? So we haven't had the full benefit of that. So there's things, they think they might be able to do another one. I don't know if we have enough parts to do that, but they seem motivated to want to do it, which is super positive. So I think there are some other efficiencies that can come through the business.
I think an important feature that probably didn't come out in the presentation is that a lot of the margin improvement happened in the second half of the year. So whilst you've got the full year impact of a reduced possible turnover because of the brand rationalisation, you've got a full year looking forward at higher margins than these results show, because they include lower margins at the beginning of the year.
Hi there, Matt Butland from Allenby Capital. Firstly, on the stock, the inventory that you've taken 2 million out, which is nice big figure. Initially, I thought that was probably because you've rationalised the SKUs, but then Qadeer, you mentioned, I think it was bottom left of one of the slides, it's more efficiencies in the amounts that you've been ordering, etc. So just wondering if you could give a bit more information on that. And I guess my concern would be that if you are running inventories too low, you run the risk of not being able to deliver to customers. So how you've balanced that?
Yeah, to be fair, that efficiency has largely been generated as a result of reducing purchasing quantities and the manufacturing quantities. So those two have to be in sync for us to be essentially able to deliver to the end customer. So far, with those inventory reductions, we've not seen a disruption or an ability or speed to actually meet customer volumes and demand. So what we've done is sustainable. Obviously, you can go the other way, go too far, and actually impact not only production, but purchasing, as well as meeting deadlines for customer deliveries. So that hasn't happened. I think in terms of inventory reduction, we're probably there or thereabouts, where currently we're at 8.2 million in terms of a closing stock value against 10 million last year, 10.2 million last year. And the composition is right now between raw materials, finished goods, and WIP. So finished goods probably accounts for about 55%, raw materials being about 45% of that stock value. So I think while there are still some opportunities from a stock obsolescence and making sure we get rid of some noise, I think we are probably at a level that is sustainable going forward, and it's just not a quick win.
I think just to add a little context to that, it's a good question actually, because you can run too lean and then you're missing out on sales opportunities. And we have historically done that kind of activity, so very aware of it. We've actually been working with some of the key retailers, and we focus now on top 20. What you realise is that actually the top 20 products swing everything in terms of the sales. So we used to take more of a, particularly on private label, we'd put buffers in so we had headroom on every single product we supplied. We don't do that anymore. So we focus on the big SKUs with the retailers in partnership with them, and actually probably hold a little more, but they churn quickly. So you're never going to sit on it too long if you put too much stock in, but we don't do it at the bottom end anymore. So it's been more of a kind of calculated, instead of a one-fits-all approach. And I think Qadeer's right. We always said 8.2, 8.5 is probably, with the current level of sales, is where it works, and it's getting that balance right. That's a good question.
Second question, private label, that's obviously the bit that's growing the best, and just trying to get a feel for how you're winning business compared to your competitors.
We're in a really nice position with private label. We're probably one now of only 3 or 4 in the UK that are doing it, and 10 years ago that would have been double that. Some of you may be familiar with McBride's, the big household. Yeah, they pulled out of personal care about 5-6 years ago, just could not make it pay, so they don't do personal care anymore. And we've had other competitors that have just decided to become contract manufacturing organisations. It's a much easier transactional relationship for some manufacturers. They just want orders and deliver, and don't develop. So from a competitor point of view, it's actually quite low in terms of who we go up against, which I think is a little frustrating for some of our retailers. Actually, gosh, you've got to brief Potter & More again. Potter & More are the ones that can deliver this. But from our point of view, it's obviously a really strong position to be in.
Thank you. Final question. I'm just trying to understand what's going on in the sector because I'm quite new to it. But I saw Reckitt's this morning announced they were rationalising their portfolio. And I appreciate them getting rid of something is pretty big. But is that generally going on in the sector that, and could this throw up opportunities, some of the bigger players deciding to cut products?
Yeah, I think that is a trend across the board. I think, manufacturers particularly, and we were hit so hard. We were hit by 15% during that inflationary period. It was phenomenal. So you had to look internally. You had to figure out how you were going to move forward. And what happens with a branded business, particularly when it's growing, I mean, we cut 170 SKUs from branded. I looked at it and gone, why didn't we do that 3 years ago? You look at yourselves and think, we should have, but when you're growing, it gets all a bit loose at the edges, right? And it's not until you're faced with something that you have to do it. And I think that's the same with all, and Reckitt's being a manufacturer, I think it's very similar. I think what's also happening in the industry is retailers want more out of less. So that's also pushing that. So they may be finding, like we did, that those additional SKUs that make a brand and make the whole consumer journey actually are just getting cut and not getting the distribution because retailers want to get more out of less. So yes, I think that generally is the case, absolutely.
Hi, thank you very much for the presentation today. It's actually really important as an investor to meet with the company. And I know the past couple of years that hasn't happened. So thank you for restarting these. It's really good. I've got a couple of questions. One is obviously the past 24 months has been pretty turbulent for the company. What lessons have you and the company taken from that time?
I think some of those we've highlighted, that keeping your eye on the ball when you're growing in terms of those key metrics. And I think that SKU rationalization piece and making sure that every product that you're manufacturing is making a contribution, I think that's been a lesson. I think in terms of saying no, we actually say no to retailers quite a lot in terms of if it just doesn't fit for us. We've had an opportunity recently on private label. They're saying, why won't you do it? It just doesn't work for us. It just doesn't fit what we want to do. I think that's important. And I think that's about keeping that margin up. That's about keeping that value in the business. I think that's been a big lesson from the front end of the business. I don't know if you guys have got comments from the kind of operational side.
Well, brand acquisition, I suppose, is a
big
learning.
Acquisition. Yeah, the acquisitions definitely. I think that's been a big learning. I think I highlighted in my presentation. I actually have seen it as a positive thing in that we've really figured out what we do well and what we can turn and what we can do. So in terms of things that now come across the desk, of which there are stuff coming across the desk all the time, there's a lot of activity going on. Being more analytical in terms of, okay, well, we know how we did that. We know what we can do. We know what our strengths are. Is that something that we could really, do something with? So I think that's been a big learning as well. And I think keeping the overhead of the business in line with the cost profile, I think we allowed our overhead to be determined for growth, and that growth then just didn't come. And I think it's trying to keep that closer aligned moving forward. And I know there would be a view that investing in resource and overhead for growth is an important thing to do, but I think in manufacturing, you've got to keep yourselves flexible and agile. Hence the skilling up piece. I think that's really important. I think if we can get more skill into the business, it adds more value. So ultimately that probably means less labor with AI and better skill, which then, allows you to be more agile and grow. So yeah, there've been some lessons too. Training and skilling up, I think, has been.
And I think just to add to that, obviously, since I've been here, almost approaching 2 years now, I think communication is really important, both internally and externally. Obviously, as you mentioned, it's quite important from an investor perspective. We're trying to get back to that. But communication internally, taking our team, employees along with us on the journey and giving clarity about what it is we're trying to achieve, how really clear metrics like the 6-point plan to say, okay, this is what we're trying to achieve and how we're going to go and achieve that. I think not being complacent just because a function has worked really well, having buffers in place, it's a comfort blanket. I think Pippa touched on it before in the presentation was, we've got the warehouse facility on hand. It's easy to kind of, have that as a safety blanket or manufacturing quantities to meet end consumer demand. But ultimately, we've got to stress test and see actually, is that best for the business and can we be leaner, meaner and fitter, to be fair? So I think those, communication, really important. and being dynamic.
I suppose from my point of view, I've been in my role just over 2 years now. Before heading up all of our manufacturing, I was in a technical role, R&D and quality and so on. And I've tried to bring those strengths into a manufacturing environment. So building relationships with our OEMs, getting them on site, doing training with our key setters, engineers, process people and so on. Building better relationships with our packaging equipment suppliers and so on. We've reaped massive dividends there. We've had to pay for some of it. We've paid for people to come in and train our people, to upskill them. And that's how we've been able to increase efficiencies by doing these things, working hard, investing in training, getting the right people on board to do that as well.
Great, thank you. And that leads nicely on to my second question. You mentioned in your presentation that the new management team is highly motivated. Can you talk a little bit about how you're motivating them, and also whether you and other directors have invested in the business as well?
So yes, myself and Martin, as the two executive directors, are invested in the business. We have been for some time. In terms of motivating the team, I think it was about a bit of restructuring. I think it was about giving more responsibility and more headroom to a number of key individuals. I've been really surprised by just giving people some headroom, how they kind of perform. And that's been really exciting to watch. And I think knowing that they're part of it, we're very transparent as a team in terms of keeping them at that senior team level. I mean, we meet at 9:30 every day, all of our senior team members, all heads of department, for a 9:30 huddle every morning. We hit the key things. It's an opportunity for me to update on anything or to engage them in what might be going on in a bigger sense. So we stay really, really connected in terms of our messaging. And also, people have the freedom and the headroom, I think, to contribute and know that their ideas are going to be listened to and that they can actually impact something. And the warehouse project is a really good example of that. We had a chap that was heading up our purchasing, and we promoted him because we could just see the skill set to head up our logistics and warehousing. And within 6 months, he has motivated the warehouse team with his management style, completely looked at the warehouse from a very logical kind of point of view, consolidated pallets, changed pallet sizes and all this stuff, and literally changed our entire profile of how we can do the warehouse. So we're just promoting him to do planning as well now. We're taking him even further up because I think he can do that with our planning of our factory. So I think it's about headroom. I think it's about people knowing that the contribution that they make can really make a difference and kind of doing that. So I think that's been key. Yeah,
and transparency, autonomy, responsibility.
Yeah,
really.
100%, yeah.
Is there an employee share ownership scheme or anything like that?
There is, yeah. And there are a lot of those individuals I talk about that have been with us, have got options, have bought those options over a period of time. So yes, there is, yeah.
Peter Renton from Cavendish. Looking 5 years ahead, how do you see the revenue split across your private label, contract manufacturing and brands? Just interested to see where the growth is expected to come from. And then secondly, you mentioned about M&A opportunities coming across your desk. How likely would you say it is that you would execute on any of that over the next, say, 18 months or so? What sort of size could that be? What sort of categories might you be interested in? That'd be helpful. Thank you.
So to answer the first question, the growth will be in private label and branded. I don't see our contract division growing unless something fundamentally changes in terms of, and I'll tell you why. Contract manufacturing over the past 5 years has seen a lot of much smaller contract manufacturers in the UK come into business. Much smaller than us, don't have the resources that we do, and therefore are coming to market with much lower prices. That's fine. that's okay with us. So I don't see it coming from contract manufacturing. If good business walks through the door, which a couple of pieces have recently, absolutely we'll take it. But it's got to meet that profile of margin and return. So private label, absolutely. And I think I explained into other categories and maximising how much we do with all of those key retailers. The obvious answer is, of course, brand. And, ideally, I would want brand to be the bigger share. And as you can see, it's almost as big as private label now. So that's quite interesting, bearing in mind about 13 years ago, we didn't even have any brands. And we've been doing private label for forever. So that, brand has the international opportunity and the digital opportunity. Obviously, private label doesn't. So brands will also be the driver. So it's those two categories predominantly. And, crystal ball, will one grow faster than the other? In theory, you say it will be brand, but actually private label is doing so well. It's just where the market's at. And that's because it's on the agenda of the retailers big time at the moment. So if you're on an upswing in terms of what they want to do with private label, then obviously you take all of that advantage. So hopefully that answers that part of the question. The second part was about M&A. I think we have an appetite for it. Are we ready for it right now? I don't think that we are. I still think we're very focused on wanting to grow these core brands and take advantage of what we're doing in private label. But if the right thing came across the desk, that wouldn't preclude us from doing it. I think in terms of size, that's a difficult question to answer because it would depend on the opportunity. There could be something that's down at 2 million that we just go, that's amazing. There could be something up at 10 million. So I think that's quite difficult for us to kind of assess. I think it would depend on the opportunity. I think that's it's a hard one to answer, but we have an appetite for it. It's just got to be the right thing. We want to know from day one that we can look at it and go, we know how we can turn that. We know how we can make that work. I think that's really important.
Certainly, it'll be much more critically appraised than we have done in the past.
Hi, Giles Belleni from Cavendish. You mentioned AI a couple of times, and obviously I can understand how things like automation and things will improve efficiencies in your business. Just interested to see how you think AI might provide you some opportunities in your business.
Well, the areas I'm focusing on are data recovery, paperwork, quality control systems, artwork checking, label checking, carton checking, things like that. Those are things that are very close to hand at the moment and will speed up a lot of the internal checks. We still have a lot of paperwork within the business, and taking that out is a key, but it's got to be right. Part of the strength of our business is the controls and things that we have in there at the moment. So wherever we fetch in, it's got to be validated, work well, and be what we want in terms of keeping our records straight and so on.
So some of those things Martin's highlighted are obviously services to manufacturing. They're actually reasonably low cost, but could actually make quite a big difference in terms of efficiencies, labour, and the use of people. So that's where we're focusing, because we think there's some low-hanging fruit opportunities there. I think in terms of where do we go beyond that, it's very difficult for us in manufacturing because we have set ourselves up to be a very flexible, agile, multi-category, multi-component. We're not running the same thing for 4 days. We could be changing a line 2 or 3 times a day in terms of the types of things we do, which does limit a little bit how automated you can go. But I think there are definitely these kind of AI opportunities, Martin says, on data.
We're constantly sort of reviewing potential robotics and things like that as well, but it doesn't really work in our business at the moment. You're really looking at might work for larger run suppliers, like McBride's of this world, where you're running 500,000 units one after the other. But it's got to be equipment that's going to be utilised, can be changed quickly, and allow us to, reap the efficiencies that it's supposed to deliver.
Hi, Pippa. You made reference to the formulation bank. Thank you for the presentation. It's great work all round. You mentioned the formulation bank. How do you value that? And more importantly, how do you leverage the value in that?
It's interesting. I'm not quite sure how we value it. We leverage it by being able to move very quick with other opportunities. So whether we've developed in private label or developed in brand or developed it in contract, there's a way to kind of move that between the different revenue streams so that we can launch new products. So top example that's happened recently is I wanted to get some SPF products into our branded portfolio in the discount sector as quick as we possibly could. We happen to have done some SPF elsewhere a couple of years before, and we've just harnessed that and put it straight into that and delivered it into the discount sector. So I think we're leveraging it all the time by having our R&D team communicate to all of our 3 teams to make sure everybody in the business always knows what we've got and what we're developing, and then pushing that into brand or pushing that into private label opportunities all the time. In terms of valuing it, it's not an exercise we've ever done, is it? And I'm not sure where we'd start with that. But because, we effectively fill gunk into bottles and jars, right, and tubes. So that's the source, that's the recipe, that's the thing that is actually of value. Yes, we do all these other things in terms of creative and distribution and all of that stuff, but that's the heart of it. That's the product that you're actually, using.
We have the formulations, Martin. How many of them? 4,000.
We have our formulation database is built on some proprietary software called Creativity. So, we can access it in many different ways. Type of product that we're looking for, does it have to have SPF value? So we can search the database very easily, and we're also sort of adding enhancements to it at the moment, which will group products so that if our sales team are looking for particular types of products, particular ideas, ranges or whatever, we can give them options, and that creativity will allow us to give them options on cost, texture, elegance, and so on, all the key things that are important to selling the product. And across the range from, micellar waters, toners, water-thin products that may, relatively low cost, to creams which can be, hundreds of pounds a kilo. And everything in between that,
I think it's fair to say that the R&D overhead cost, it's an overhead, but it is almost a business stream for the business. So new product development and our ability to get products to market quickly is one of the USPs of the business. And there is a significant investment in that stream in the business. And we could look at putting a multiple on that, but you're talking, what, £600,000, maybe more in terms of R&D costs
a very
annually.
Very important part of that library as well is the regulatory part of it as well, so that we know that what we pull off is legal, can be used. The EU makes life very difficult for pharmaceutical and cosmetic manufacturers with constant changes in regulations, checking out raw materials which have commonly been used for years and years.
A very live example of how that's such an important part of our business is we've recently gone after 2 pieces of private label business. We are rarely the cheapest in manufacturing for private label. And in both instances with 2 different customers, they said, but we're coming to you because you've submitted the best quality performance formulations out of the whole pack. And you win because if they're the right retailer, and that's why I say best in class retailers, that's what they'll make the decision for their consumer. They want the best product. So it helps us win business. And you all probably know, those that know the beauty industry, that the dupe trend is enormous at the moment in the beauty industry. And that's where retailers, trading brands, other brands are literally duping what premium brands are doing. And that's actually being quite disruptive to the market at the moment. And I refuse to take us into those aesthetic dupes because I know the consumer will always come back and the retailer will always come back to performance products. Because if you're putting stuff on your skin, you're using it on your hair, you're doing whatever, you ideally want a product that's going to perform. So again, that goes back to our R&D and why we put such an emphasis on it, because there are plenty of trading opportunities out there for us to do those kind of aesthetic dupes that we're turning down all the time. Because I think we have a belief in the business that performance of our product and keeping that in our brands, in our private label, wins this business. And it does. Those 2 examples, recent examples, proves it. The right retailer will pay more for the right performance product.
Just interested, how you mentioned you'd like to get back to 60 million. How far, given your current business model, do you think your assets can take you before you have to go to a major step change?
In terms of operational capacity?
Yeah. How much revenue do you think you've got?
Yeah, I think moving to 60 million isn't going to impact. I think we've done it before. It's completely within our sights, particularly if we keep focused on that tail and we keep focused on the obsolescence, because it's amazing how much, when you look at it, capacity is taken up by doing that kind of thing. So I think that's a big lesson that we've learned, is making sure we're focusing on the right things. I think it depends on how that revenue comes, because if it comes in value and less volume, then that's a different profile to doing big volumes and what that would drive in. So that's I don't know if you guys have got an answer to that specifically, but I think, the 60 million is within our sights and where we want to be. I can't see that that's going to make any major changes to us.
The long thing is, with a single shift across 2 sites, you could double the sales in the long term. There'd be a lot of investment in terms of people and resources to achieve that by putting a second shift on. But that's all, that's all possible if the margins are right. And
Paul is right. We could put additional lines on an evening shift if we were required to, We have got a skill base that would allow us to do that, and we have people that would be prepared to work evening shifts if they want to. I would, if we made that decision, it would have to be, based on good, strong forecasts, and that, a skill up an evening shift the right way probably take me 3 months to do it properly.
It could be done incrementally rather than.
Yeah,
you could go
certainly.
120 million.
We wouldn't have to
but
go
incrementally
straight
without-
to a full-out evening shift. We could pick our 2 fastest lines and recruit for those if that was what was required. I would love to be able to run those lines flat out for 24 hours, but we can run them very effectively as we are at the moment. But we have got a lot of capacity if it was required to be used.
Hello, it's Leo. I'm a private investor. Thank you for inviting us all and giving us this access. Much appreciated. Question about, I think you've reiterated the 9-month return hurdle for investments. Could you describe what kind of investments that pertains to? Because I guess it's not product development and so forth. But could you just say what that does apply to and why it's such a short period?
Yeah, I think that 9-month payback period was part of the 6-point plan, and that strategy was right for that moment in time. I think at that point, when we're going through a transition period with the challenges of the macroeconomic environment, every pound was effectively held ransom. Now we find ourselves in a different, place, and actually that strategy no longer potentially sits with how we want to grow the business and move forward with the business. So now we have a different outlook, like you said, in terms of automation, AI. It's a different spin on it. The 9-month payback period isn't quite relevant now. It's actually looking at its impact on the business, able to generate capacity, asset utilization, efficiencies, manufacturing efficiencies.
Okay, and nonetheless, you've the fact you now feel you have more capital is made clear by the fact you've started paying a dividend again. You've restarted the dividend. That seemed to me slightly premature. Where was that coming from? That pressure to resume a dividend? Which shareholders? Was it institutions?
It was. There is some shareholders there and the aspirations for dividends. I think the reason for doing that is we looked at the business and where we turned it around to. We looked at the cash position, and then we looked at what we believed we could fulfill going forward without straining our resources. And we roughly set the dividend at around about 3 times cover, which is not a particularly ambitious figure. And that's what we said we believe as a business we can deliver going forward, as long as the cash flow it maintains its positive contribution. So we've got lots of already in place structured debt that can more than meet the working capital growth needs of the business. If we need to do significant acquisitions, we've got fixed asset acquisitions in place. If we need to go out to a brand, then a bigger capital expenditure, then we may have to revisit that, but that will be a much broader shareholder engaged discussion. So I think it's the right thing for us to do at this point in time. And frankly, it's a message that we feel, where we feel in the business at the current moment in time.
Jeff Jones, a private investor. You made some overhead cuts late in the second half of the year. Exactly when were those made?
Overhead cuts is effectively split into 2. Your administrative cost savings and also your distribution and warehouse costs. The administrative cost reductions happen over the full 12 months, I'd say. And the H2 really we accelerated in terms of moving the distribution and warehousing in-house. Really the benefits of that were in H2 as opposed to H1. And as Pippa mentioned, that's a product of reorganizing or realigning employees to kind of suit that objective.
Thanks everybody. Thank you.